There is a war happening right now between what the market believes and what the institutions that actually move trillions of dollars are forecasting. And the gap between these two views has never been wider. If you are making financial decisions based on the assumption that rate cuts are coming, that relief is on the way, that the Federal Reserve will ease monetary policy and bring down your borrowing costs, you need to hear what I am about to tell you, because some of the most powerful financial institutions in the world are saying the exact opposite. They are saying rate cuts are not coming. They are saying the next move by the Federal Reserve could be a rate hike, and they are positioning their clients' money accordingly, while retail investors continue to believe a narrative that may be completely wrong. Let me start with the most alarming forecast because it comes from J.P. Morgan, one of the largest and most influential banks on the planet. Michael Feroli, chief U.S. economist at J.P. Morgan, no longer expects any Federal Reserve rate cuts before 2027. Let me say that again so it sinks in. J.P. Morgan does not expect a single rate cut in all of 2026. Not one. The policy rate, currently sitting at 3.5 to 3.75%, will hold at that level through the entire year, according to their forecast. But it gets worse. J.P. Morgan is not just forecasting no cuts. They are projecting that the Federal Reserve will hike rates by 25 basis points in the third quarter of 2027. That would bring the upper band of the policy rate back up to 4%. The same bank that manages trillions in assets is telling its clients to prepare for higher rates, not lower rates, not relief, more pain. And J.P. Morgan is not alone. Macquarie, Australia's largest asset manager, is making the same call. Their chief economist, Rick Deverill, has argued that as tariff effects fade and global industrial production recovers, growth will pick up and central bank easing will end. In that scenario, he said, the Fed will likely be hiking again in late 2026. Not 2027, late 2026. That is less than a year from now. Meanwhile, derivatives markets continue to price in 2 quarter-point cuts this year, according to the CME FedWatch tool. 2 cuts. 50 basis points of easing. That is what the futures market is betting on. The gap between what retail traders believe and what institutional economists are forecasting is not a minor disagreement. It is a chasm. It is the difference between planning for lower mortgage payments and preparing for higher ones. It is the difference between expecting your credit card rate to decline and watching it climb. It is the difference between financial relief and financial devastation. And here is what should alarm you most. If institutional forecasts prove correct, if J.P. Morgan and Macquarie are right and the market is wrong, current pricing would need to adjust sharply. That adjustment will not be gradual. It will not be gentle. It will be sudden and severe. Positions built on the assumption of rate cuts will be liquidated. Bond prices will fall, yields will spike, mortgage rates will climb, and everyone who is counting on the Fed to ease will find themselves facing the exact opposite scenario with no time to prepare. Now let me show you what the Federal Reserve itself is saying, because the January meeting minutes released this week reveal a central bank that is far more hawkish than most people realize. The Fed held its benchmark short-term rate steady in a range between 3.5 and 3.75% on a 10-2 vote. That decision to hold was expected, but what was inside the minutes was not. Most FOMC officials describe the risk of persistently elevated inflation as meaningful. That word, meaningful, is central banker language for significant and worrying. They are telling you that inflation staying above target for an extended period is not a minor concern. It is a meaningful risk that is shaping their policy decisions. The minutes showed officials were hesitant to cut interest rates further. They want to see more progress on inflation first. More progress. That implies the progress so far has been insufficient. And when you look at the actual inflation numbers, you understand why. Core PCE inflation, the Federal Reserve's preferred measure, is running at almost 3%. That is not close to the 2% target. That is a full percentage point above it. And it is not moving meaningfully lower. In December, core PCE rose 0.4% month over month. That is double the 0.2% monthly pace that would be consistent with 2% annual inflation. The Fed is not seeing the progress it needs to justify cuts. Supercore PCE, which strips out housing and focuses on services inflation tied to labor costs, is running at 3.3%, even higher than headline core. The sticky components of inflation, the parts that are hardest to bring down, are still elevated. And several policymakers cited businesses planning further price increases in 2026 due to ongoing cost pressures. Inflation is not just elevated now, it is expected to remain elevated because businesses are telling the Fed they intend to keep raising prices. Here's the part that nobody wants to talk about. Some FOMC members raised the possibility of renewed rate increases if disinflation stalls. Rate increases, hikes, not cuts. The very thing that JP Morgan and Macquarie are forecasting is being actively discussed inside the Federal Reserve right now. The officials who set monetary policy for the largest economy on Earth are considering raising rates, not lowering them, and the market is pricing zero probability of that scenario. The CME FedWatch tool shows a 95.9% probability that the Fed will maintain current rates at the March meeting, a 4.1% probability of a cut, and effectively zero probability of a hike. By April, the probability of rates remaining unchanged is 83%. The probability of a cumulative 25 basis point cut is 16.4%. By June, the probability of at least one cut rises to 44%. But rate cut expectations have already been pushed back significantly. Just weeks ago, markets were pricing a meaningful chance of cuts in the first half of 2026. Now that possibility has been priced out. LSEG data shows traders now fully expect the first cut to come in July at the earliest. Every data release, every Fed statement, every piece of evidence is pushing the expected timing of cuts further into the future. Barclays and Morgan Stanley have both pushed their expected first rate cut to mid-2026 at the earliest. Goldman Sachs still pencils in 2 cuts this year, but frames that view as conditional on labor market weakness and acknowledges near-term uncertainty. PIMCO's economist Tiffany Wilding said officials are in a good place to react to incoming developments, but stressed there is no sense of urgency to ease. No sense of urgency. That is another way of saying cuts are not coming soon. Luke Aben, chief economist at Van Lanschot Kempen, said if the strong labor market reports of recent months are confirmed, both in job creation and wage growth, the picture could look different. If the policy rate does come down, he said, it will probably not happen before the start of the second half of the year, at earliest. That is the optimistic scenario. The pessimistic scenario, which JP Morgan and Macquarie are forecasting, is no cuts at all and eventual hikes. Now let me show you the political dimension, because something unprecedented happened this week that threatens the independence of the Federal Reserve itself. The New York Fed released a study last week showing that U.S. importers bore 94% of the cost of tariffs in the first 8 months of 2025. 94%. That means American businesses, and ultimately American consumers, paid almost all of the tariff costs. Foreign exporters absorbed almost none of it. This finding contradicts the White House narrative that tariffs are paid by foreign countries. The president has repeatedly claimed that tariffs generate revenue from China, from Mexico, from other trading partners. But the Fed's own research shows that is not what happens. American importers pay the tariffs. Those costs get passed to American consumers through higher prices. The tariffs are a tax on Americans, not on foreigners. Kevin Hassett, director of the National Economic Council and a senior White House economic advisor, responded to this study on CNBC. He called the report an embarrassment. He said the authors should be disciplined. Let me make sure you understand what just happened. A White House official publicly attacked Federal Reserve researchers for publishing findings that contradict the administration's political narrative. He did not dispute the methodology. He did not provide alternative data. He called for the researchers to be punished. This is an attack on central bank independence. The Federal Reserve is supposed to conduct objective research and set monetary policy based on data, not political preferences. When the White House demands that Fed researchers be disciplined for publishing inconvenient findings, it sends a chilling message to every economist and analyst at the central bank. Produce research that supports the administration or face consequences. And this is happening at exactly the moment when the Fed chair transition creates maximum vulnerability. Jerome Powell's term ends in May. Kevin Warsh, Trump's nominee to replace him, is awaiting confirmation. Senator Tom Tillis has said he will oppose confirming any Fed member until an investigation into Powell is resolved. Without a confirmation vote, Powell could remain in office beyond May. The entire leadership of the Federal Reserve is in flux. The White House is attacking Fed research. Political pressure to cut rates is intense despite inflation running a full point above target, and the market is pricing in rate cuts that institutional economists say are not coming. Mohamed El-Erian, former CEO of bond giant PIMCO and advisor to Allianz, said the increasingly divided Fed is reflecting both the complexity of the current economic landscape and the lame duck status of the outgoing chair. The Fed is paralyzed by division at exactly the moment when clear policy direction is most needed. Let me show you what Kevin Warsh represents, because his nomination adds another layer of uncertainty to an already chaotic situation. Warsh was a Fed governor during the 2008 financial crisis. He has been a critic of large-scale asset purchases, arguing that successive rounds of quantitative easing inflated asset prices and widened inequality. But Warsh was nominated by President Trump, and Trump has been explicit about what he wants from his Fed chair. He wants lower rates. He has publicly demanded rates as low as 1%. He told NBC News he would not have nominated Warsh if Warsh wanted to raise rates. So what will Warsh actually do? Michael Feroli at JP Morgan expects Warsh initially to argue for rate cuts, but he says Warsh's stance could shift. As time goes on, his leanings will be more open to revision and perhaps reversion back to a more hawkish view, Feroli wrote, particularly after the midterm elections. In other words, Warsh might deliver the cuts Trump wants initially, but once political pressure subsides, he might revert to his natural hawkish instincts. This creates a scenario where you could get rate cuts in the second half of 2026 under Warsh, followed by rate hikes in 2027 when Warsh no longer needs to please the White House. That whipsaw easing followed by tightening would be enormously disruptive to financial markets, to businesses trying to plan, to households trying to budget. And there is another possibility. If Tillis blocks Warsh's confirmation, if Powell remains in office beyond May, the entire transition gets delayed. Powell has been holding rates steady despite intense pressure. He has prioritized the data over political demands. A Powell who knows his tenure is extended might continue holding, waiting for clear evidence that inflation is returning to target before cutting. That means no cuts in the first half of 2026, and potentially no cuts in the second half either if the data does not cooperate. Now let me show you the labor market, because this is the other half of the Fed's dual mandate, and it complicates everything. The unemployment rate stood at 4.4% in December. Most FOMC members saw signs of stabilization rather than renewed weakness. Layoffs remain low. But hiring is subdued. The labor market is not collapsing, which would justify rate cuts, but it is not booming, which would justify rate hikes. It is in a fragile equilibrium that could tip either direction. Governors Waller and Moran, the two dissenters who voted to cut rates at the January meeting, argued that policy remains meaningfully restrictive and that downside risks to the labor market deserve more weight. They wanted a quarter-point cut to provide insurance against potential weakening. But other officials warned that a low hiring environment could make the labor market more vulnerable to shocks. If demand softens, unemployment could rise quickly. Business contacts also pointed to uncertainty around artificial intelligence and automation as factors holding back recruitment. Companies are hesitant to hire humans when they are uncertain whether AI will eliminate those jobs within a few years. For the Fed, this mix complicates decision-making. A resilient labor market supports the case for higher for longer rates. A sudden deterioration would revive the easing narrative, but neither scenario is clearly dominant right now. The labor market is stable but fragile, giving the Fed no clear direction. Feroli at JP Morgan put it bluntly. The proposition that rates are restrictive looks increasingly untenable. He is arguing that the current interest rate level is not actually slowing the economy. If rates are not restrictive, there is no reason to cut them. And if the economy accelerates, there might even be reason to raise them. Let me bring all of this down to what it means for your money, because the abstract debate about Fed policy becomes devastatingly concrete when it affects your household finances. If you are waiting for mortgage rate relief, you may be waiting far longer than you expected. Rate cut expectations have already been pushed from June to July. If JP Morgan is right, there will be no cuts at all in 2026. Mortgage rates, which are influenced by Treasury yields and Fed policy expectations, would remain elevated throughout the year. The 6.5% 30-year mortgage rate that is crushing affordability right now could stay at that level or even climb higher if the Fed eventually hikes. On a $400,000 mortgage, the difference between a 6.5% rate and a 5.5% rate is approximately $250 per month. That is $3,000 per year. Over 30 years, that is $90,000 in additional interest you pay if rates stay elevated versus if they fall. And if rates rise to 7% or higher, the additional cost climbs further. If you are carrying credit card debt, high rates are extracting wealth from your household every single month. The average credit card rate is above 20%. Each quarter-point Fed cut would reduce that by roughly 25 basis points. But if cuts do not come, your rate stays above 20%. On $10,000 in credit card debt, that is over $2,000 per year in interest charges. Money that could be going to savings, to investments, to your children's education, is instead flowing to credit card companies because the Fed cannot cut rates while inflation is elevated. If you have savings, the situation is more complex. Higher rates mean higher yields on savings accounts and money market funds. A savings account paying 4.5% gives you a real return of 1.5% if inflation is 3%. That is better than the negative real return savers earned when rates were near zero. But if inflation stays sticky at 3% and rates hold steady, your savings are barely keeping pace with prices. You are not building wealth, you are treading water. If you hold stocks, the implications are significant. Rate cuts are generally positive for equities because lower borrowing costs boost corporate earnings and make bonds less attractive relative to stocks. The market has been pricing in 2 cuts this year. If those cuts do not materialize, if JP Morgan and Macquarie are right that no cuts are coming and hikes might follow, equities could face a significant repricing. Albin at Van Lanschot Kempen said in the short term, fewer rate cuts than expected could create headwinds for equities. But he added that overall the picture remains positive because equity markets are ultimately driven by corporate earnings, which depend on economic momentum. The question is whether economic momentum continues if rates stay elevated longer than expected. If you are planning major purchases, the uncertainty makes every decision harder. Should you buy a house now at elevated mortgage rates or wait for rate cuts that may never come? Should you finance a car at current rates or delay the purchase hoping for lower rates later? Should you expand your business using debt at current borrowing costs or wait for cheaper financing that might not arrive? The gap between market expectations and institutional forecasts means you cannot know which scenario to plan for. If you plan for rate cuts and they do not come, you made decisions based on a false assumption. If you plan for rates to stay elevated and they fall sharply, you missed opportunities. The uncertainty itself is a tax on your financial well-being because it prevents rational planning. Now let me show you why the inflation problem is so stubborn, because this is the core issue preventing the Fed from cutting. Investors may be focusing on the wrong inflation gauge. The consumer price index tends to dominate headlines, but the Fed's preferred measure is the Personal Consumption Expenditures Price Index, or PCE. And PCE is telling a different story than CPI. The Fed minutes showed core PCE inflation running at almost 3% in December. CPI has been running lower, but the Fed does not set policy based on CPI. It sets policy based on PCE. And PCE says inflation is a full percentage point above target with no clear path lower. Several policymakers cited businesses planning further price increases in 2026 due to ongoing cost pressures. The survey data shows companies intending to raise prices, not lower them. That forward-looking indicator suggests inflation will remain sticky even if backward-looking data shows some improvement. Others warned that easing policy, while inflation remains elevated, could be misinterpreted as implying diminished commitment to the 2% goal. The Fed is worried about credibility. If they cut rates while inflation is at 3%, markets might conclude they are no longer serious about the 2% target. Inflation expectations could become unanchored, and once expectations are unanchored, bringing actual inflation back to target becomes far more difficult. This is the trap. The Fed cannot cut because inflation is too high, but political pressure to cut is intense. The White House is attacking Fed research. The incoming Fed chair was selected specifically because he would cut rates, and markets are pricing in cuts that the data does not support. Something has to give. Either inflation falls enough to justify cuts, or expectations adjust to match the reality that cuts are not coming. The adjustment process, whenever it happens, will be painful for anyone positioned on the wrong side. Let me show you what comes next, because the data releases over the coming weeks will determine which scenario unfolds. January PPI data is coming this week. Consensus expects a 0.3% monthly increase, with the annual rate slowing to 2.8%. A stronger than expected reading could further constrain the Fed's policy flexibility. Higher producer prices suggest higher consumer prices to come, reinforcing the case for keeping rates elevated. Several Fed officials have already reinforced the hawkish message. Chicago Fed President Goolsbee and Governor Barr have both signaled support for keeping rates in restrictive territory longer as growth cools but does not stall and fiscal and trade policy uncertainties persist. The Fed is not preparing to cut, it is preparing to hold, and it is leaving open the possibility of hikes if inflation does not cooperate. The market is pricing 95.9% odds of no change in March. That is essentially a certainty. April is 83% odds of no change. June is still only 44% odds of at least one cut. The market has already adjusted significantly toward the hawkish view. But if JP Morgan and Macquarie are right, even more adjustment is needed. The divergence between rate futures and sell-side forecasts has widened in recent weeks. That divergence will resolve one way or the other. Either the institutions are wrong and the market is right, meaning cuts will come this year, or the institutions are right and the market is wrong, meaning no cuts are coming and positions need to adjust sharply. The 94% tariff number that the White House attacked tells you something important about inflation. If importers bore 94% of tariff costs, those costs were passed to consumers through higher prices. The tariffs contributed to the inflation that is now preventing the Fed from cutting rates. Trade policy has monetary policy consequences, and the chaos around tariffs, Supreme Court rulings, executive order replacements, new 10% global levies, creates ongoing uncertainty about prices that makes the Fed's job harder. I am not a financial advisor, and nothing I say should be taken as financial advice. But what I can tell you is that the comfortable narrative about rate cuts coming to provide relief is not matching what the largest financial institutions in the world are forecasting. JP Morgan says no cuts until 2027 and hikes after that. Macquarie says hikes by late 2026. The Fed itself is discussing the possibility of rate increases, and the market is slowly, reluctantly adjusting its expectations toward this more hawkish reality. The gap between retail expectations and institutional positioning is where financial damage happens. It happens when people make decisions based on one narrative while the smart money is positioned for a completely different outcome. It happens when rate cuts that were supposed to arrive in June get pushed to July, then to September, then to 2027, while household budgets stretch to the breaking point, waiting for relief that never comes. The Fed is not keen on cutting rates, that is the headline, but the subtext is more alarming. Some officials are actively discussing rate hikes. The largest banks are forecasting no cuts and eventual tightening. The White House is attacking Fed research that contradicts political narratives. And the Fed chair transition creates uncertainty about who will be making decisions and what their priorities will be. Subscribe to Market Acme right now and join our WhatsApp community for real-time updates, because the next few months will determine whether the rate cut narrative survives or collapses entirely. Every inflation print, every Fed statement, every piece of economic data will either reinforce the case for cuts or further erode it. I am Kenzo John. I am not a financial advisor. This is Market Acme, and I will keep showing you what the institutions are actually forecasting, not what the comfortable narrative claims. Because in an environment where JP Morgan says no cuts until 2027 while the market prices 2 cuts this year, someone is catastrophically wrong, and the gap between those views will close one way or the other. The only question is whether you are positioned for the outcome that actually unfolds, or whether you are holding on to a narrative that the data has already destroyed. The Fed is holding steady, inflation is sticky, rate cuts are being pushed further into the future, and some of the smartest money in the world is preparing for hikes instead of cuts. The divergence between what you are being told and what is actually happening has never been wider, and the resolution of that divergence will determine the trajectory of your mortgage payments, your investment returns, and your financial security for years to come. Join our WhatsApp community for updates as this situation develops, because it is developing fast, and the decisions you make based on understanding the real picture rather than the comfortable narrative will determine whether you come through this period intact or whether you become another casualty of the gap between expectations and reality.